Alright team, Greg here from BCR with a update in the currency market. Okay, so the big focus in the currency market has been the yen. So almost on a daily basis, we've seen the yen weaken to new 38-year lows. And against the USD, we've traded up almost as high as 162. Overnight, we had some top-tier US data in that we had US ISM services data. Now that data came out much weaker than expected. That caused US bond yields to fall about 10 basis points across the board, and that also saw a much weaker US dollar. However, these conditions are generally very favourable for yen strength, but we did not see that for the yen at all. And dollar yen actually still closed the session overnight close to 162 even still. So it must be a massive concern for the Japanese and the MOF, the fact that even when the yen now has favourable conditions, it still fails to strengthen. So look, the next hurdle that the yen and the Japanese have is going to be with the non-farm payrolls print that we see on Friday. And so look, the big concern that they're going to have is going to be twofold. One is if we have what happened overnight, if we have a weaker payrolls print, we see bond yields fall again, and we see a weaker US dollar across the board, and we fail to see the yen strengthen on that again, it'll be a massive red flag for them. And secondly, obviously, if we see a stronger payrolls print and we see bond yields go up and a stronger dollar, and then obviously dollar yen breaks through 162, I see that both scenarios are something that obviously the Japanese will not, obviously they're not going to like, right? So I would assign quite a big probability that if either of those scenarios panned out on Friday night, that highly likely that they'll use Monday morning when we've got illiquid markets to finally intervene in the market. So certainly on Monday morning, I don't think, or going home on Friday night, if the yen certainly is weak, look, I wouldn't be long dollar yen going into the weekend. In other news in the currency market, the Aussie has finally broken its range. The Aussie for 2 months was trading a range of 65.80 to 67 cents. It was quite boring. But finally, on the back of that weaker ISM number overnight and weaker US yields, Aussie broke above 67 cents. It was also helped by the commodities going higher and the fact that risk is making new record highs. So Aussie does look like a good trade, especially if we see a weaker payrolls print on Friday. Then I'd say that this break above 67 cents certainly will be a decisive break, and we finally will see a directional move on the Aussie, and I'd be targeting levels above 68 cents in the short term. So look, good luck with the trading towards the end of the week. Obviously, with US being out for 4th of July celebrations tonight, it's going to be quiet leading into payrolls, but certainly after payrolls we'll check in again.